for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. That's right, it's Thursday, which also means that Michael Lebowitz is joining me this morning for the Think Tank, and we're going to be talking a little bit about inflation. Of course, that's the report coming out this morning. We've had a lot of economic data out this week. We're all getting kind of caught up now with after the post-government reopening. We were getting the employment data out. We're getting inflation report this morning. Inflation reports expected. Depending on how you look at Nomura, JP Morgan, Goldman Sachs are all kind of estimating right now an average of about a 0.25% increase. Now, let me just explain to you, that's absolutely ridiculous to go to 2 decimal points, right? I mean, you know, if you can actually gauge inflation at that level nationwide, good for you. But you know, we have to do something to justify our positions and our jobs, so there you go. But so expecting a little bit of an increase this morning, about in line with historical averages. So again, I don't think it's going to move the needle much. But again, a hotter print this morning, a 0.3 or a 0.4 on inflation would certainly kind of potentially weigh on markets further. Again, markets have been weak here for the last few days. We'll talk about that in just a moment. But again, we'll have that inflation data out this morning. You know, but again, looking at some of the recent economic data, in fact, this is going to kind of be the subject of this weekend's Bull Bear Report. So if you haven't subscribed to our weekly newsletter, it's probably the most important work we do every week. We cover markets, technical analysis, the backdrop of the markets, kind of market rotation, sector analysis. We do all that. It's every Saturday, and that's the only place it's published is on our website, realinvestmentadvice.com, and on Substack at Lance Roberts. So if you want our newsletter, make sure you subscribe to one of those two places, and we'll get that to you. But this weekend's newsletter, we're going to talk about why the economy looks to be undermining the Fed's soft landing narrative. The recent employment report was a good indication of that. Economic demand is clearly slowing, and there's a lot of expectation next year that we're going to have this resurgence of earnings growth and activity for companies. In fact, as we talked a little bit about yesterday, touched on that yesterday, is that they're expecting massive earnings growth for the bottom 493 stocks next year, even though they haven't been able to do it over the past 3 when the economy was really good. So, you know, there's a lot of bets going on for next year, a lot of optimism. We'll kind of see how it plays out. We're going to kind of go through the economic backdrop this weekend of what's been going on with now that we have some of this recent data, we can get caught up. So we'll have that kind of backdrop in the newsletter this weekend. Outside of that, though, you know, markets are continuing to you know, kind of really work through this kind of chop. So that brings us to what you need to know before the bell this morning. I talked about yesterday that this market, you know, has been a little bit weak yesterday, has been weak lately, and has been selling off. And we were sitting right there on the 50 and the 20-day moving average. We took that out yesterday pretty decisively. And that has now, you know, triggered a pretty clear MACD sell signal on a short-term basis. Markets are getting oversold here on a relative strength basis. But again, markets can remain oversold longer than you think. They can also remain overbought longer than you think. But typically, with markets, just historically speaking, you can stay overbought for a while, but bottoms tend to be fairly short-lived. So when you get relative strength oversold, that tends to portend to at least a short-term bounce in the markets. Again, the violation of the 50 and the 20-day moving average is certainly concerning, but don't knee-jerk react to that saying, okay, oh my gosh, you know, we're going to have this bigger sell-off. We could, but we also have seen plenty of periods where markets have broken support like this and immediately recovered like the next day or two. So really what's important, remember, as we've talked about before, when you have a break of a moving average, what's important is where you end the week. So if we end the week below these moving averages, that does suggest some further weakness going into the Christmas shortened trading week next week. But we have also had 4 straight days of sell-off here. So again, just from a sell-off standpoint, the markets are getting a little bit extended here. So I would expect a bounce of some sort, maybe a day, maybe 2 at least. But some type of reflexive bounce here. And again, futures are pointing up a little bit this morning. So again, I would expect a bounce here. Now, if this little sell-off here, again, this is really minor, but this has been really weighing on you the last couple of days. Like, oh my gosh, I'm just, this market's just really weighing on me and I can't sleep, I'm stressed out, whatever the reasons are. use a bounce to reduce some equity, right? I mean, take some profits off the table, rebalance. Again, if you haven't done tax loss selling, this is the time to do it right now. Rebalance your portfolio going into next year. There's some stocks getting relatively cheap here and oversold on a basis. So if there's some stocks you've been looking to add to your portfolio, this bit of a sell-off has been giving you a little bit of an opportunity to buy some stocks cheaper. Again, you have to be selective, but again, there's some opportunities also being generated here as well. So again, just pay attention to this. This isn't a major critical, everything's kind of coming apart, but there's clearly weakness in the markets right now that you need to be aware of. We've been watching this kind of sell-off the last couple of days, and we've now kind of taken out some support here. So that is certainly a concern that kind of lifts the kind of the warning level a bit here for the markets as we're getting ready to head into year end. Now, real quick, we have talked about this, while the market itself is selling off, that has really been a lot of the function of the mega cap stocks. And if we take a look at a performance comparison again and we've talked about this the last few days, if we take a look at a performance comparison again, we've really started to close this gap in performance between the equal weighted index and the market cap weighted index. And that's a function of the fact that really the big mega cap stocks haven't gone anywhere for a while. They've been under pressure, but Nvidia is trading about, and Microsoft and Amazon, they're trading about the same levels they were a year ago. So they really haven't gone much of anywhere. And that's that lack of performance in those mega cap stocks is allowing the breadth of the market to kind of catch up. So we're seeing a little bit of a rotation. Energy performed well yesterday. We've seen healthcare perform well lately. We've seen some movement back into staple stocks. So again, just kind of paying attention to the market itself is also going to give you a little bit of an opportunity to look at some things to maybe add to your portfolio, reposition, etc. For instance, we've talked about staples here for a while. Staples have just been a very, very weak underperformer over the last year or so. Nobody's really talked about it much, but look at this little run we've been having in staples here as of late. We've talked about this recently, is that look for that kind of defensive rotation, but this is also why you're starting to see a little bit better performance in market breadth, because now these areas of the market that have been really underperforming of late are really starting to show some signs of life. We're seeing some of that rotation out of risk into more defensive areas. Take a look at energy as an example. Energy had a good day yesterday, but again, there's been a nice little uptrend. Energy sold off, previous to this bounce yesterday, but nice little uptrend that's been building kind of an XLE as well. Again, they're not setting the house on fire by any stretch of the imagination, but this is kind of the point to look at. Utilities are very, very oversold here. Again, from a defensive positioning, this is where a lot of dividend yield comes from for dividend yielding portfolios as well. But utilities have been in a lot of pressure. They're coming down to test their 200-day moving average, really oversold on both a momentum and a relative strength basis. So again, here's an area where we may see, if this market kind of sell off in the mega caps and we start getting a bit of a rotation into the markets, we may see a bit of life come back into more defensive areas. So just some things to pay attention to as you get ready to go into year end and think about kind of rebalancing, repositioning your portfolios. All right, that's what you need to know before the bell this morning. We're going to come back and pick up with Michael Lebowitz. We'll talk about the Fed. We're going to talk about is the 60-40 allocation dead? We had an interesting email from a client yesterday asking about the 60-40 allocation and sent a long article about why the 60-40 is dead. We'll discuss that this morning. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So before we get to
Michael Lebowitz this morning. I just have a very important announcement to make. It's been 15 years in the making, actually closer to 18 years in the making. And it's taken me a very, very long time to get to this point. And it's been a challenge. 18 years I've worked at this one single goal for 18 years. And that's to win an argument with my wife. And I've now officially done it. And I have evidence that I have won an argument with my wife. And I just texted her this morning. My wife's traveling right now. She's in Boise, Idaho, working on a transaction. And so when she wakes up this morning, she's about an hour behind us. She'll have a text on her phone with evidence that I have finally won this argument. Because for the last several years, she and I have argued that Die Hard is not a Christmas movie. And I have explained to her that clearly Die Hard is a Christmas movie. And there is Christmas celebration, there's a party, there's all kinds of stuff going on.
Yeah.
And she argues with me is that absolutely not, it's not a Christmas movie. It cannot be watched over Christmas because it is not a Christmas movie. And ladies and gentlemen, let me present my evidence. This was a survey that was done by Charter. And you will note that number 5 on the list is, it's not, you would think that it's The Wonderful Life, right? You would think that, it's the most important Christmas movie of the year, but absolutely not. Number 5 on the list, Die Hard.
There you have it.
And there you have it. And I have evidence. I have proof. This is the number 5 most favorite Christmas movie in America.
Yippee-ki-yo-ki-yay.
Exactly. Or something to the effect that you can't say on
Exactly.
radio. Actually, we can't because we're on YouTube now. So, but
we probably shouldn't.
But you should probably insert that one clip. So anyway, I was kind of surprised that Charlie Brown Christmas was number 2. But I get it, right? Miracle on 34th Street's way down the list, and you have to get nearly to the bottom to see It's a Wonderful Life or The Grinch. So
It's a Wonderful Life,
yeah.
man.
But I have seen Red One, which was the least on this particular list, right? And that's a very new movie, so I'm surprised it was actually on the list as a favorite Christmas movie. But
They have better PR.
yeah, probably true. Anyway, so
This
is a good day. This will go down in history. I will probably never win another argument with my wife. And she's still gonna refute this, by the way. Don't think for a moment that she's gonna let this go. She's still gonna refute this, and
She's going to
argue with me
question the
about
source of the
absolutely.
of the poll.
She will question the source. Absolutely. She'll say it's fake news. So, all right, let's get to work this morning. Mike, welcome to the show. How are you?
Good. Can you, a little bit later today, can you give me a little tutoring? Because I've been married 30 years and I have yet to win anything. If you could help me out, that would be great.
Sure. It's called sheer luck. That's all it is. Anyway, so a couple things just real quick here, and before we get into our bigger topic. Inflation's out this morning. Kind of what's your expectation? What do you think?
They're saying 3.1. We'll see where it comes out at. It's this data is hard to figure out what's going on because of the months that we've missed and how is that going to play into the number. But, the market's expecting a 0.3 increase and 3 to 3.1. So my guess is it'll be on, what the market's expecting, but you never know with the BLS.
Well, it's true. Like I said, JP Morgan, Goldman Sachs, and Nomura are all expecting 0.25% this morning. So, it'll be somewhere between 0.2 and 0.3, right? So,
the funny part is if it's 0.2, they round it. Right. So if it's 0.2, right. There can be a decent difference, but they're going to round it one way or another.
Yeah.
And look, at the end of the day, we both know it doesn't matter which way they round it or how many decimals. It's a very faulty gauge, but the direction of the gauge is what matters, and how is it trending up or down.
Yeah, exactly. All right, well, let's talk a little bit at first about your article that you wrote earlier this week. It was an interesting kind of comment. Talking about this again. This was going to be the debate. We talked about this, I think, last week or the week before, whenever the last Fed meeting was. Time flies right now. But, they announced this kind of reversal of policy. They ended QT and they talked about buying $40 billion worth of bonds as part of their reserve management. Now, what's key is if the Federal Reserve is buying short-term bills, it's reserve management. If it's buying long-term bills, from the Fed's view, it's quantitative easing. But again, it's been the debate you and I talked about has come to fruition. There's been a lot of debate in the media about, is it QE, is it not QE? So you wrote an article yesterday kind of explaining the difference in what it is. So go ahead.
It's QE. And really what drove me to write the article was that Bitcoin has become a proxy for speculation, for liquidity in the system. So I kind of just started looking at the correlation between reserves and Bitcoin prices. And what I found is that there's a very strong correlation, not surprisingly, between Bitcoin prices and reserves. And I use reserves as a liquidity measure because that's what the Fed kind of directly impacts when they're doing QE or QT or many of the repo programs that they're doing. So it's funny. I kind of really think it's funny or ironic that Bitcoin is this decentralized, it's heralded as decentralized. It's out of the system. Mm-hmm. It has no impact on it's not impacted by fiscal monetary policy. It's its own unique thing. Well, its price is very highly correlated with the level of reserves in the system.
Right.
So, if you own Bitcoin, just understand, I'm not saying Bitcoin's good or bad or whatever, just understand that what you're really betting on is liquidity in the system.
Right.
So once I kind of looked at Bitcoin, I decided to take it a step further, and I started looking at various equity indexes, equity sectors, equity factors, and a few other asset classes. And not surprisingly, what you come up with is the same thing, that there's a high correlation, a high R squared between equity indexes, the S&P 500, the NASDAQ, between most equity sectors. Interestingly, transportation's materials have the highest correlation, the highest R squared to the level of reserves. They're kind of the most economically impacted. However, utilities, energy, staples to a lesser degree have a very low correlation. So when you start thinking about this, the Fed's doing QE, should I buy Bitcoin? Well, it has a high correlation with reserves, and reserves are going up. Maybe we should focus on transportation and materials. And if you want to hedge bets, you go with utilities or energy or staples because they don't have a relationship with reserves. Yeah, and I kind of end it by looking at just some random other asset classes. The yield curve has a decent correlation with reserves, as we would expect, but longer term bond prices don't have that great of a relationship. The dollar has a negative relationship. Corporate bond spreads have a negative but a very strong relationship, which you would expect like stocks. But Lance, the one that really got me, gold and silver,
right,
have a minimal relation, really no relationship with reserves. So, Bitcoin is often lumped in with gold and silver. And it's interesting that Bitcoin is driven off liquidity. Gold and silver just don't seem to have a relationship with it. So, the point is, QE's here, and I don't care what you call it, the Fed is putting reserves into the system, and they're not taking them out. They're not coming out. They're not doing QT. So whether they buy a 3-month bill and they keep, when that bill matures, they buy another 3-month bill, or when it matures, they buy a 20 or 30-year bond. It doesn't matter. Those reserves are being put into the system, and it will start likely impacting stocks. And that's what the analysis tells us, is that there's a decent correlation between that. And, so the question may be, well, the Fed started QE a couple weeks ago. Why hasn't it mattered? It takes a while. They're pumping gas into the car. It just doesn't fill up automatically. They're doing 10 billion a week. That may not even be enough to offset the natural decline in reserves. So it's going to take a while for for the tank to fill up and to start impacting some of these sectors. Now, look, the correlation is not 100%. There's other factors that drive all of these equities, these assets, these stock factors. But it does have an R squared of over 50 for many of them. R squared over 50 means that basically half the price of, let's just say, Bitcoin is due to the change in reserves. So it is a big player in what we should expect going forward. And look, QE is they're going to be doing QE, they said, for, I think he used the word a few months, or he put it out till February or March. I forgot what it was. But it's going to be 40 billion times 3 or 4.
Well, and it's interesting because, JP Morgan is the cause of the liquidity crunch that was happening in the repo market. It was an interesting article out this morning showing that they've been withdrawing so much from the repo market that's what's been driving the repo problem. And what's interesting is they've been moving money out of the Fed and into treasuries. So I think the interesting dynamic of this is, while everybody's running around saying, nobody wants to own treasuries, one of the world's largest banks has been aggressively moving money from the Fed to buy treasuries. And what do you make of that?
Besson gave him a tap on the shoulder. Can you help us out? I don't know. I mean, obviously
it did. The drain of repo is why the Fed took its actions and reduced QE and stopped QT and started QE. There was clearly a tie to that. I guess the question is what's going on with JP Morgan, and is this something we should be concerned about?
You could also say maybe they're being a little speculative. They think that in the coming year, and this has been widely publicized, is that the largest banks are going to get capital relief, which makes it much more advantageous to hold U.S. Treasuries. Maybe they're trying to get a jump on the other banks before they start buying.
It's interesting that you would say that because BankReg Data's founder, Bill Moreland, said it's clear that JP Morgan is migrating money at the Fed to treasuries. Rates are going down, and they're going to front run this. And the Financial Times goes on to note that the scale of JP Morgan's withdrawals was so large that it offset the movement of cash in and out of the Fed by all of the rest of America's 4,000 plus banks. Since the end of 2023, the total amount of cash banks have on deposit at the Fed is down from 1.9 trillion to 1.6 trillion. So again, if you're looking, this also kind of undermines this whole outlook of potentially a soft landing scenario in the economy. And JP Morgan's probably front running that. I mean, you take a look at the recent employment data, that is not soft landing type data that you'd be looking at. Inflation data, retail sales data, all of that's telling you that the economy is slowing down a whole lot more than you expect. And that's going to translate to lower yields next year.
Right. And again, we've talked about this. The sentiment is huge for personal consumption. Personal consumption is 2/3 of the economy. And when people feel at risk of being laid off, at risk of not getting a raise, when they see a neighbor get laid off or a colleague, or just when they see the unemployment rate rising, when they see that there are jobs that, there's negative job growth, it impacts their consumption decisions. Now, it may be masked right now because of the holidays, and this is the hardest time of year to tell what's going on in the economy. There's all kinds of temporary hiring going on. People are buying things they wouldn't buy, for presents. They're spending above their means, knowing that come January, February, March, they're going to cut back. The patterns of when they spend. Is it Black Friday? Do they wait till the very end where they think they get deals? Did they start buying in October? So, what we see in employment, we may not match in other economic data till we get to February, March, April. But it's just something to be on the lookout on, because you're right, the data is pretty poor on the employment front.
It is, and I think this kind of leads us into this conversation as of late. There's been more and more articles out written by people about the 60/40 model's dead, and what's interesting is that just like 3 months ago, you and I were talking. I think it was you and I, or maybe it was me and maybe it was just me and Danny or somebody. But anyway, we were talking about here on the show that there's this conversation out there by some of the big guys in the financial marketplace. Jeff Gundlach, BlackRock, others saying, well, you should ditch your 60/40 and do 60% stocks and then have the other 40% in gold and Bitcoin. And then Bitcoin has absolutely decimated you. And the problem that I think we're getting into in terms of the 60-40 allocation is a bit of history in terms of people are expecting bonds to generate these outsized rates of return, but we were going from 6 and 7 and 8% interest rates down to near zero. And so you had a lot of capital appreciation on your bond side of your portfolio, but that's not what the bond side of your portfolio is not built for bonds to generate a capital appreciation. The bonds are there to create an offset of risk, lower volatility, and create income and preserve your capital because bonds pay off in maturity. But we've kind of gotten into this period over the last 20 years where it's like, oh, I could buy bonds and make stock-like returns, but that was never supposed to happen. And it's not going to happen in the future because we're now down to where economic growth, interest rates are trading where economic growth and inflation are. So there's not a lot of room to move lower from here, but they're probably not going to be moving up from here either. So you're now going to start to revert back to a 60-40 allocation of what it was meant to be, which is to provide stability, lower volatility, and income. But, kind of your thoughts here, Mike.
That's exactly. And it's interesting that we're hearing things like this when stock valuations are at or near record highs. Mm-hmm. And, you've shown this before, I've shown it, the Cape 10. So when you look at, a kind of more historic PE valuation that goes back 10 years on earnings, it has a very good job of predicting what the returns are going to be like for the next 10 years. Not how we get there, not what next year is going to be or tomorrow, but over 10 years, those returns are below Treasury returns.
Right.
So if you were going to create a portfolio today that you're going to put away, you're going to buy you can buy the S&P and you can buy bonds, and whatever allocation between the two, just put it away for 10 years and look at it. Statistically, the more bonds you have, the better off you're going to be. Doesn't mean you're going to be better off next year, but again, we're not looking at this for 10 years. Mm-hmm. So the point is, and I think gold is kind of a lesson in this. There's what's called the all-weather portfolio or the permanent portfolio, and it's precious metals, stocks, and bonds, about a third. And in 21, 22, it would have been very easy to say, what are you doing? Why do you own any gold?
That's dead.
Gold's gone nowhere since 2011. It's stupid. That third leg of the bar stool hasn't done anything for you. Well, that third leg of the bar stool has been very important. And the reason it is because it's a diversifier. It provides something that the other two don't. Mm-hmm. That's the same thing with fixed income and bonds. It's providing stability. It's providing a lower risk. And it's providing a return that over 10 years should be better than equities. As crazy as that sounds, at about a 4% yield.
Well, no, and let me be really clear here. We're talking about individual bonds. Now, that can consist of corporate bonds, municipal bonds, treasury bonds. We're talking about actual bond ownership, not buying an ETF. There's a big difference between an ETF and bonds. And again, when you're building a 60-40 allocation, that should be in individual bonds because that 40% of that allocation that's in bonds, the whole reason that you own a bond is there's only two reasons you own a bond. You don't buy it, again, as I said before, you don't buy a bond for capital appreciation. That's not the goal. If you want to buy a bond for capital appreciation, buy a zero coupon, right? Because that's going to mature at face value, so you have capital appreciation. But you buy a bond because at maturity, it gives you back 100 cents on the dollar, and treasuries are guaranteed to do that. Corporate bonds, you run corporate risk on. Municipal bonds, you run municipal risk on. Even though municipal bonds are insured, you still have a risk out there. So there is a risk that those don't mature at face value because of bankruptcy, defaults, et cetera. But government bonds are going to pay off at face. So you have that return of principal at maturity, plus you're going to get 4% a year. So if I can buy a 10-year treasury at 4% a year, I'm going to get 4% every single year on that bond, and I get all my money back in the future. Now, why would you not want that? And again, as we've said before, when you're building an allocation model, that's where you're looking at. You're looking at the three legs of the stool of your portfolio, and your portfolio should have all three legs of the stool. If not, you're giving up a return source. So you have the income from bonds, you have the dividends from dividend yielding equities, and then you have your growth component from equity, so capital appreciation. So capital appreciation, income, and dividends are the three legs of your total return portfolio, and that's what gives you long-term returns. And so from Mike's point, when you're talking about 5-year, so if you look at, and I just showed you all this graph earlier this week, but if you look at the CAPE 5, right, which is just the 5-year CAPE ratio, and look at where valuations are going to be from current valuations over the next 5 years, that's near zero. 10 years is below zero based on current valuations. 20 years based on current valuations is about 2% in total. So if I've got a 4% coupon bond right now that I can lock in, I'm going to outperform the markets over the next 20 years just by owning those bonds based on valuations. Now, does that mean that absolutely has to happen that way? No, absolutely not. But where we make the mistake, and this is the mistake that's being made by people saying, oh, the 60-40 is dead, is because they're looking at it from a strictly capital appreciation basis. Last year, I mean, bonds have had about a 1% rate of return this year on a capital appreciation basis. So then throw in your 4% dividend yields, you're about 5% on bonds, total return for the year. That's not terrible, right? It's just not 17%. We've gotten so used to having these big return years where we're making 6, 7, 8, 9, 10% returns on bonds that we've forgotten why we actually own the 60-40 allocation, which, by the way, is the best allocation model historically going back to 1900. It's outperformed every other allocation model from 100% stocks to 100% bonds. The 60-40s outperformed them all on a risk-adjusted basis over time. So again,
Lance,
go ahead.
I was going to say there's another part to that. What's the average return on equities over the longer term? And what is it, 7-8%?
Right.
Right. So this double-digit environment we've been in is also not sustainable. Realistically, even if we have average equity returns, you're comparing a 4.5% return to a 6, 7, 8% return with a lot less risk on that 4% part of it. So, I think it's the combination of poor bond returns over the last few years and outsized equity returns that all of a sudden everyone wants to jump on that trade. Time to jump on that trade was a few years ago. Mm-hmm. Now you want to kind of think the other way. Which is overvalued? Which has value?
Well, that's the interesting thing, right? That's human nature, though, Mike. We want to buy whatever performed well last year. We're not looking at the future, and so
right.
It's like there was a comment in chat: bonds aren't safe. That's ridiculous. Bonds are absolutely safe. You buy treasury bonds, you're guaranteed to get your money back. There's no other asset that's going to give you that. Equities aren't safe. Gold isn't safe. Silver's not safe. Bitcoin's not safe. You can suffer massive drawdowns in those assets. Bonds are going to give you your money back. How is that not safe? These ridiculous comments of an uneducated at best. So these are the things but this is the stuff. These are the narratives in the markets. This is the stuff that's making people make poor choices, saying, oh, I need to go out and buy the most overbought asset right now because it's going up, and ignore assets that are cheap. Staples are very cheap right now. Utilities are getting very cheap on a fundamental basis. Energy stocks are cheap on a fundamental basis. There's some asset classes out there that are going to give you outsized returns going forward based on their current valuations. I'm sorry, Mike, go ahead.
No, I was going to say it's kind of like having what you just said is really important. What if we just said, you know what, in your equity portfolio, you only need to own 7 stocks, the Magnificent 7. Don't bother with anything else. It's the same thing, but we do own utilities. We do own staples. We do own those more conservative sectors because they provide ballast. And look, this market isn't going to keep going up forever, despite what some people say. And it will go down. And the equity market can fall 20, 30, 40, 50, 60, 70% in a bad environment. All of a sudden, plus 4% or, plus 0%, and if you have money in cash, is looking really good.
Right.
And you have to think about the longer term here,
well,
not
this
what's
is,
in vogue
right,
today.
and this is the interesting comment, right? So I'm buying these other assets because, I think the stock market's going to crash. I mean, there's all these people running around, the stock market's going to crash by 50%, so I'm going to go buy Bitcoin, whatever. I'm going to protect myself from the crash. But you just showed us the R squared to liquidity in markets, right? And there's a very high correlation between assets like Bitcoin and stocks are very closely correlated. So that's not, putting Bitcoin in the safe bucket of your portfolio is not a great idea because you're putting a highly correlated risk asset in your safety money bucket. And when we're talking about long-term, by the way, we're talking about 5 to 10 years, right? We're not talking about over the next year. Are bonds going to be a screaming buy next year and outperform everything? Probably not, because we still have a lot of equity momentum in the markets. But over 5 to 10 years, that's the time frame we're talking about here. And when you're buying bonds, you're buying them for the duration, right? I'm not buying bonds for a trade. If you're trading bonds, that's a different story. We can have a different conversation. If your time frame is 6 to 12 months, that's a different conversation about owning bonds, right? You don't buy bonds for a 6 to 12 month hold unless you're just literally trading them for a reason. You just think there's going to be a move in interest rates one way or the other, and you're trading rates. That's a different conversation. That's all technical. It has nothing to do with fundamentals or economics or anything else. But long term, 5 to 10 years, it's all about valuations, economics, and fundamentals. And that's the point we're making. There's a lot of claims out there giving bad advice to people saying, oh, ditch your 40% allocation. That's your safe money. That's the money that will be there when you get ready to retire or for whatever your goal is. That money will be there. It will mature at face value. It will give you a return. You will have that asset. That is not guaranteed with any other thing that you own. That's not guaranteed with gold or silver or Bitcoin or stocks or emerging markets or you name it, oil, commodities in general. None of that's is guaranteed. But you buy treasuries, those are going to be a guaranteed return in the future.
Here's a really good analogy. You get offered a job to work at a car dealership selling cars, and they give you two options for salary. One is 100% commission. Whatever you sell, you get X commission on. And the other one is we'll pay you $50,000 a year plus a commission that's roughly 60% of what the other one was. And you can choose between the two. You may be the greatest car salesman in the world, but the economy dictates how many cars are sold. So your car sales are going to fluctuate, meaning your income is going to fluctuate. If you take the option with the fixed 50,000 plus whatever you sell, you have stabilized your income. You know that a year from now, you'll be able to eat and sleep under your roof as opposed to constantly betting on the economy. So it provides ballast for whatever your, in this case, whatever your payments are to be able to pay your bills and not have to 100% rely on one market.
Yeah. And look, and there's some comments in chat right now too, which are true, right? So, I mean, when you're thinking about your safe money bucket, right? So you talk about your portfolio and I want to have lower volatility. I want to guarantee an outcome for the future. Yes, you can use bonds for that because of the guaranteed return. And I'm talking about, when I say guaranteed return, we're talking about treasury bonds or government guaranteed to be paid. Now, again, you take risk in other type of bonds, but you can also have corporates, you can have municipals, you can have those type of bonds in your bond sleeve. And we're talking about owning the individual bonds. Those are completely fine. If you buy good quality fundamental companies, if you buy an Apple or a Microsoft bond or a GE bond, you're probably going to get your money back. Very high probability. But and to our comments in chat, yes, there's also bond-like alternatives, annuities. But you run a risk with annuities. If the annuity company fails, you potentially lose your money. So there is risk in other bond-like alternatives, and there's nothing wrong with them. Annuities are fine. You need to really understand what you're buying with an annuity and why you're buying it and payout structures, those type of things. But yes, what we're talking about in general with the 60-40 allocation is 60% is your risk bucket. So that's your stocks, your gold, your Bitcoin, your silver, your emerging markets, your international markets. That's all in your 60% bucket. That's your risk. The goal of that 60% is to outpace inflation over time. So that's where your inflation adjustment comes from. Because what you put in your safety bucket, which is guaranteed, your money's going to be there in the future when you need it. That's not going to adjust for inflation. If I have, again, 50% of my portfolio, we've used this example before because it's easy math and it's early in the morning, but 50% of my portfolio is in treasuries. I'm getting 4% yield. That's a 2% return for my portfolio. I will get that total, I will get that 4% from those bonds every year for 10 years, but it won't adjust for inflation because I get 4% this year. I get 4% 10 years from now. I do get my money back, but that money did not adjust for inflation. So I need the other 50% of my portfolio to throw off a 3% dividend yield. That gives me another 1.5. So now my portfolio is at 3.5% yield. I want to get a 6% yield out of my portfolio every year. So I've already got 3.5. I need 2.5% in growth plus the inflation adjustment. So I need that 50% of my portfolio to grow at least 2.5% to get my 6% annual rate of return that I need. But I also need another 2% a year on top of that to adjust for inflation and make sure I'm maintaining my purchasing power and cost of my dollars. So again, this is why, building your allocation properly, understanding what your time frames are, what your income needs are. That's why all these assets are important. And yes, we've been through a period where bonds have underperformed from a historical basis, but we were all used to this environment where interest rates were going from 14% in the 70s down to zero in 2020. Well, actually 0.5%, but close enough to zero, rounding down. But that environment's gone. That's never going to come back. So now we have to look at bonds for what they really are, which is safety of principal, a 3 or 4% interest income run, and then how do I blend that safety factor into my portfolio to generate the returns that I want with the volatility that I want. In other words, I'm building a risk-adjusted portfolio. So if the market does go down 40, 50%, which is possible at some point, that you don't suffer that kind of capital devastation. And that's the whole point of the conversation, is how to protect your capital from a massive mean reverting event, which will occur at some point. Don't know when. It could be a year from now, could be 5 years from now, could be 10 years from now. But at some point, we are going to have another mean reverting event. We've had them all throughout history. It will occur again. The point for this conversation is how do you survive it? Not knowing when that event will happen, because nobody does. Mike, go ahead.
And when we see headlines like, at that point, when things like that happen, they say you should be in a 20-80.
Yeah.
That's when you know you need to go to an 80-20. When they're telling you need to be in all bonds and get rid of stocks because they have no future, and they're probably dirt cheap at that point. That's the time when you should think about going back heavily into stocks. So it's again, they're just looking at the way things have been trading recently, and with stocks 20% a year for the last 3 years now.
Yep. And
bonds kicking off a kind of relatively lame 4% or so. It's easy to say 60-40 doesn't work, but that neither one is the environment that we're going to be in the future.
Yeah. So here again, the comments in chat, again, same individuals earlier. If bonds are safe, why are central banks holding gold? Well, banks hold gold. Let me explain this for you real quick. Banks hold gold as a currency reserve offset. International banks have to own U.S. dollar reserves because 80% of all SWIFT transactions, 60% of all transactions occur in the U.S. dollar. The dollar is the U.S. dollar is the reserve currency of the world. So they have to hold U.S. dollars. If the dollar is under pressure because of economic differentials, which it has been over the last year or so, then I'm going to own gold because gold goes up. And so if I have dollars in my reserves, they're going down in value. I buy an asset that's going up in value to offset that reserve balance. It's a hedge. Over the last 5 years, central banks have only added about 1% annually to their balance sheets in gold. They hold a far larger balance in bonds because that's where their reserves are actually stored in U.S. Treasuries. But to offset that declination of the dollar, they can buy other assets that are going up in value. It's simply a hedge on their books. And they're managing their currency reserve balances, and they're managing the reserve. They're managing the differential in reserve rate in the rate of the dollar versus their currency. So if the dollar's getting weaker and their currency is getting stronger, they balance those reserves to try to keep those two currencies closely in line, because if they get out of balance, it impacts their economics. It becomes an additional inflation in their economy. So it makes things more challenging. So, yes, they are holding gold. They have acquired about 5% over the last 5 years. They have increased their gold holdings by a total of 5%. So that the vast majority of the appreciation, now this is the myth that's out there. It's like, oh, look, their gold holdings have surpassed treasury holdings. That's only a function of price because the price of gold has gone up so much over the last year. When gold reverses, that will change. And you also made the statement that the BIS named it a tier 1 asset. Well, yes, gold is a tier 1 asset for holding reserves. But the BIS also, and this was last weekend's newsletter, if you would actually read our newsletter, actually just went through the BIS, the Bank of International Settlements, just said that we are in a gold and stock double bubble. And the real risk is that over the next year to two, we will see a mean reversion in both stocks and bonds because historically that's what, both stocks and gold, because historically that's what happens. So no, bonds are safe. And that's why central banks own massive quantities of treasuries. That's why JP Morgan is draining the repo market to buy treasuries, because that's where safe money goes. Mike, comments?
No, that's well said. And if that's going to happen, if stocks and gold, precious metals are going to fall, as presumably crypto is going to fall with them, where's that money going to go? There's really only one place that can absorb that kind of money. So again, the 60-40 makes a lot of sense, and you may be very happy with your 40 when these markets correct themselves.
Yeah. So again, look, it's just a function of just understanding what, if you don't understand bonds then and how they operate, then yeah, I can get where you're coming from. It's like, oh, bonds aren't safe. But that's just your lack of education, your lack of understanding about how an instrument works and why bonds are the de facto go-to for, especially treasury bonds, are the de facto go-to place for every central bank in the world, every U.S. bank in the world. They use treasuries for collateral. Why would a bank use treasuries for collateral if they're not safe? Because they're guaranteed. They're going to get paid. The government will pay them. So it is de facto guaranteed collateral for every transaction that occurs. So again, just your lack of understanding is the problematic part. And the people that are writing these articles that 60-40 is dead, et cetera, so forth, they have a severe lack of understanding about how the allocations will work in the future. They're looking at past performance over the last year and not looking at where markets are going to be 5 to 10 years from now. And there's a very different outcome in that environment. And for you and your money and your safety and your forward-looking, outlook for whatever your retirement time frame is and your wealth building activities are, to fall into the trap of chasing performance with your safe money is not a really good idea. It has never worked out well for anybody.
Yeah, and Lance, by the way, if Treasury does default on Treasury bonds, you got much bigger problems than whatever your Fidelity or Schwab account tell you your balance is. There are much bigger issues. It's not going to happen. Japan hasn't collapsed, and they have a much worse fiscal issue than us. Yep. And their economy has barely grown in 20 years, and their demographics are shrinking. So defaulting on a treasury bond is not going to happen in our lifetime. At some point, maybe it does happen, but that's not a fear that you should have right now.
Yeah. One thing we were talking about earlier too, we were talking about, building money in relatively safe assets. A couple of comments in chat as well. Yeah. Real estate. Absolutely. Not buying REIT stocks, but actually buying real estate. Yeah. Real estate is going to appreciate over time, but real estate, unlike, like bonds, can have periods of underperformance. And, real estate has had a tough sled in the financial crisis, right? Lots of people lost money in real estate during the financial crisis. You can go through those types of environments, just like we went through with bonds over the last couple of years. You can have periods where an asset that is considered to be a safe asset, where you can make large amounts of money over time, can have periods of volatility. So yeah, real estate is certainly should be a portion of the portfolio. That is you look at any high net worth individual in the world, right? They have private equity, which is primarily their business, usually whatever business they own. They have about 20% of their portfolio in stocks. They have about 30% of their portfolio in bonds. and they have a big chunk in real estate. And I'm not talking about their primary residence. We're talking about invested real estate where they're making a return. They have an asset, a real asset that they can sell in the future, those type of things. So again, that is part of the wealth building process. And you need that diversification. And this is the whole point that gets lost. We get so busy chasing the market every day. It's like, oh, market's up. I got to be in. I'm going to try to get rich quick in the markets. That never works out historically over time. People chasing markets wind up losing a vast amount of their money repeatedly. But that's why when you look at a high net worth investor, guys that have 10, 20, 50, 100, $200 million or more, they only have about 20% of their money in equities. They're not chasing the stock market. They have some money there to participate in the markets to create that inflation adjustment. But the big chunk of their money is in controllable assets. They are in bonds. They are in equity they control in corporations. They may sit on the board of the company. They may be, they may own the company, whatever it is. But they have control over the future and outcome of that asset. They have control over real estate. You don't have control over equities. You're simply just trading pieces of ethereal paper, hoping that you're going to get a higher price for it at some point in the future. So that's why, when you're thinking about building your wealth profile, the amount of equity you own in the stock market should become less and less over time. Because again, that's not guaranteed. That is pure speculative risk. Everything else that you want in your wealth bucket should be controllable outcomes. I can control the outcome with bonds. I can control the outcome with real estate. I can control the outcome with equity that I own in businesses. That's how you build real wealth over time. If you want to become wealthy, that's what you want to be focusing on, is controllable wealth, not risk wealth. Mike?
Diversification matters. I think we could have summed up we could have saved everyone a half hour. Diversification really matters. Yeah. And when people don't think diversification matters, that's probably the time you really should be thinking about diversifying. And it's really that simple, regardless of what it is, whether it's bonds, whether it's real estate, whether it's utilities instead of technology. Diversification really matters. And there's books upon books, finance books written on this topic that have proven it.
Yeah. Real quick, just let me clarify a point. I said real estate, not REITs. REITs are fine, but REITs are an equity that you're trading in the market. So again, it's in that equity risk bucket, and you're subject to interest rates. So you're trading off of it. REITs are basically a trade on interest rates, and they go up and down in value over time. You can price them every day, but and the same thing's happening with actual real estate. Real estate actually trades values every day, just like just like the market, but you just don't see it because you're not selling your asset that day. So it lowers that volatility risk profile in your portfolio. REITs are fine; they have a good dividend yield, but you're going to track that volatility in your bucket. So again, REITs should be in your equity bucket because of the volatility risk. And again, everything we're talking about today, to Mike's point, talking about diversification, what we're talking about is controlling volatility so you can survive when we have those 20, 30, 40% drawdowns. That's how you survive them, and you come out on the other side of the game. Most people don't survive the drawdowns. And there's plenty of there are plenty of skeletons out there from the financial crisis, from the dot-com crisis, of people that got absolutely decimated, never came back into the stock market after that. Same thing happened after the Depression. So again, when those things occur, and they do occur, the goal is to survive them. And the only way you survive those things is through proper diversification and volatility, i.e. risk controls. So, all right. Thanks, Mike. Appreciate it very much. Make sure that you have gotten your ticket for the upcoming Economic Summit, January 17th. Mike will be there to talk all about bonds, the Fed, the outlook for next year. We'll be covering markets, economics, cryptocurrency, artificial intelligence, all kinds of stuff, financial planning as well. It'll be a good event. Get your ticket now online, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate it very much. Keeps us getting good guests here on the show as well. And have a great week. We'll see you back here on tomorrow for Financial Fitness Friday.